Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for ChartsandMarkets.com. Well, welcome back to the show, Bob.
Here we are again, another fascinating week in the financial markets.
Bob, we have a number of questions from our listeners, so let's get to those right away. We have a question from Kate, who says, Bob, I am a gold bug and very fortunate to be so in the current environment. Your calls on the precious metal sector have been great. However, I am tempted to become a commodity bug as well, but I'm not sure how long until a good entry point will happen. I understand that a bust in financial asset bubbles are often followed by a new commodity boom. Bob, how long until or if we can expect the start of the next commodity boom? I don't want to be a commodity bug flying into the windshield.
Oh, that's a good close on that question. The key question is, will commodities get a boost? And the inflationists and gold bugs are all out in full force because the Fed is seen to be going on to a reckless phase that is without precedent. But there's a certain pattern to financial history, and it overwhelms what central bankers can or hope to do. And your basic gold bug these days is founded upon what was happening in the 1970s when it was time for inflation in commodities and the CPI and wages. So everybody learned then, and it was really quite daring at the time, that the Fed was a danger, and its depreciation will drive commodities to the moon forever. But like everything else, it gets overdone. But then with the great boom in commodities, and we had the last big one was kind of a paired top there, 2008, 2011. And when they crashed, it set up another decade of inflation in financial assets, which is what we have had. And then for natural reasons, it reached the top in January and then crashed, made worse by the coronavirus hysteria. So, of course, this then has got all the central banks going about buying bonds out of the market, and you got your basic gold bugs are out there calling for $10,000 gold. But sure, one can criticize the Fed, but every central bank in every reasonable country is doing the same thing. So then why would the U.S. dollar go down relative to other currencies? The other one is that the idea of that a credit contraction can be fixed by the sudden fashioning of credit out of thin air, and the nonsense that more credit will make a credit contraction go away, that goes all the way back to the early 1600s. And also in the 1700s, John Law came out with the same recipe. More credit will make a credit contraction go away. There was another guy in the 1800s. Oh, yeah, then also Walter Bagehot, the esteemed editor of the Economist magazine in London. So the key central bank or other central banks in a post-bubble contraction have all eased. Even the Federal Reserve in 1929, the New York Fed bought bonds out of the market and exceeded its authority by a factor of 6 times. That's pretty radical. And then in 1932, Barron's had an editorial pointing out that none of the anti-deflationary measures are working. And the anti-deflationary measures, of course, were buying bonds out of the market. So a financial crash is not new, nor is the notion that it can be ended by an extraordinary introduction of credit by central banks. So I'm going to stay with history. I really don't have the imagination to invent something new. So it's highly unlikely that the Fed recklessness will depreciate the dollar, because it didn't do it in 1929, but what the mechanism seems to be is that on the boom, which is more than the stock market, which gets all the press, is a huge bubble in debt. And most of it is written in the financial center, which is still New York, and due and payable in U.S. dollars. So the debt bubble is essentially a huge short position in dollars. So I'll stay with the pattern. You have a long economic expansion that culminates in commodities boom, crash. Then you have a long period of a new financial era where the inflation is in stocks and bond prices, then crash. And that possibly the peak in January could have been the peak in the latest bubble, and you get a crash. Now then, despite what central bankers have done in the past, you then go into a lengthy post-bubble contraction. So, but here's where the first part of your question is about gold, is that with this post-bubble contraction, gold's real price goes up, and making for more profitability for gold miners. And the reason why they're profitable is because you have a bear market in industrial commodities. So weak crude oil prices means weak energy and blasting costs for mining. Weak base metal prices means overcapacity in base metal mining, which shuts down, which then gives you lower cost equipment and mining wages for the gold side, which does well. So basically the inflation has had a big rush lately with the recklessness of central banks, but I don't think it'll hook up. I think we're in a post-bubble contraction. But the shining part, the lustrous part, will be gold, that gold will do really well, and gold miners.
And Bob, we had another question from Bert Wenkenbach from the Netherlands, and his question essentially was the same with all the central banks around the world buying up assets like crazy. The European Central Bank has 40% of European bonds. The Swiss National Bank is the biggest shareholder of Apple. He says they can monetize half the world. So while a lot of markets may be broken, no one in his right mind will enter them, but they're not going to collapse either because of all this. So could this time, at least temporarily, be different?
Yeah, Bert. Yep. It's always tempting to say that this time is different, but let's just be clinical about it. In last summer, the yield curve inverted, which was due to speculative demand for short-term money driving the short rates higher than long rates. And on our chart back to 1857, every time the U.S. curve has inverted, it preceded a recession. And that's pretty hard evidence. Now, there was also a fancy part to it, whereby in December, speculative urges then inverted the curve again, so you had a double top or a double inversion. And the last time that happened was in 2007. And then it happened definitely with the 1929 bubble, double inversion, and also with the 1873 bubble. And then with the 1873 bubble, the New York Herald editorialized that nothing could go wrong because the United States did not have a central bank constrained by a gold standard. It had the national banking or the treasury system, and the editorial was highly confident that the treasury buying bonds out of the market would prevent a contraction. The Depression ran from 1873 to 1895. So this is where history says that central bankers do the same thing each time when a bubble crashes, and you still have the contraction.
Gavin from Ireland has a question. There's currently a lot of hype surrounding Bitcoin's upcoming halving event where miners will be awarded half the coins. What is Bob's view on Bitcoin's status to become the next reserve currency? Does Bob follow Bitcoin's trading patterns? And while we're saying hi to Gavin, I'll say hi to all my relatives in Athlone, which is dead center Ireland. At least that's what they claim.
Good for you. Good question. Well, we did follow the trading pattern. That was right up till December 2017. I think it was the 17th or 18th when we got the sequential sell on the action. Hadn't had one of those. So technically, we traded the Bitcoin, and with that blow-off, have more or less put it on the back shelf. The popular uprising that's going on is an attempt to reform big and intrusive government. And one of the means of funding big and intrusive government has been central banks attempting to provide it unlimited funding. And the public will demand a sound currency. And sound in the past has meant convertible into gold. Now, whether an agency or an interested party can create the equivalent of a gold standard with the conveniences of a Bitcoin, who knows? But the end result will be that more than likely the public will demand a gold standard on most currencies.
We'll have more with Bob Hoye right after this.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Athlone, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Welcome back. We're speaking with Bob Hoye. Bob, one of the headlines that you picked up on just before we started the show, companies are dangerously drunk on debt. Well, are they drinking their own poison?
I guess so. But that was from the Financial Times, which is a pretty good headline. And it reminds of the old saying is that when the Federal Reserve is the bartender, everyone drinks until they fall down. And that there's a lot of truth to that. And, the debt burdens are immense, but you had such compelling reasons. For example, you had very low interest rates for most corporates, and the stock market was doing okay. And this is going back over the last decade, and under the Obama administration, the economy was not that dynamic, and so companies then took to buying their stock back. And it made it even more fun when you could issue debt at very low rates. So the whole game became compelling, and the stock buyback game for Boeing, for example, is an atrocity. But at any rate, though the action in a financial mania gets very compelling, and people do, in retrospect, very reckless things. And indeed, the partiers drank at the Fed bar until they got drunk and fell down. But I just love the Financial Times when they come out with a direct headline like that.
Should stock buybacks be banned? We have the airline industry in the U.S. that bought back $45 billion in shares and now has got a $25 billion bailout from the government.
Yeah. The idea of a omniscient and omnipotent government guiding financial history is ridiculous. Just look at it, Jim, this way. That the Fed is not going to allow anything to go wrong removes risk from the equation. So in times in the past, you've had great financial bubbles when the senior central bank was on a gold standard and therefore somewhat accountable. And you can have a huge financial bubble in stocks and bonds and real estate without a central bank being reckless. So, but when you do have, as it has been over the last 30 years or so, very aggressive central banking trying to prevent bad things from happening, well, they get across the idea that there is no risk. Well, in the last couple of months, there's been a sudden discovery of risk, although it came from a contagious disease. It will still have the same effect. So, no, I think the hands-on from central banks as a long policy game is going to be come under scrutiny, and the folks will make an attempt to make sure that recklessness doesn't happen again in the future. But in the meantime, these guys have got a lot of power and a lot of determination that'll take an incredible decline in the financial markets to prevent them from being reckless.
We'll have more with Bob Hoye right after this.
Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Bob Hoye. Bob, another headline that caught your eye. Hedge fund stock exposure highest in 30 years. What's that all about?
No, that's 3 years.
Or 3 years. I'm sorry, I can't read my own handwriting.
This is an interesting one because this was published on May 4th by Bloomberg. And what it says is that the hedge funds have bought heavily towards the bottom. We hope the best ones were at the bottom. So they ended up being the biggest position in 3 years, and that, of course, may be temporary. I think whoever those main hedge funds were acting aggressively on a collapsing market, which I admire. And then the next half of this will be them reducing their positions on strength as it appears. And on speaking of which, it was back in March when we noted that heavy liquidations can last for as long as 2 months, which took us out to the end of March, and I think the low was March the 23rd, And then we published a piece called Let's Be Constructive. And so generally we're playing the seasonal positiveness that can carry through into May or June. That's the old saying of sell in May and go away. And sometimes it looks like May could have 8 weeks as you go into June. So, yeah, this is quite simple. Positive in stocks and bonds and industrial commodities toward mid-year, and we'll be watching for technical excesses. And then after mid-year, perhaps in August, we'll start to remind people that, hey, markets are vulnerable in the fall, and then you'll have the next heavy decline for crude oil into late in the year, maybe January or February. And there's some irony here, because in late December I wrote that crude wasn't excessive at the time. I just reminded people that our long-term target was for $27. I think in December it was at 55. And that was then, to throw a little irony in, that was on annual averages. And then bang, you had the utter collapse of it. And then through various technical reasons, the front month contract did go negative to minus 40. That's complicated and exceptional, but at any rate, when it was trading at 10, let's say a more realistic price was at 10, then that made us bullish when looking for a $27 annual average. So anyways, it'll be interesting to see how this goes through the rest of the year. But after August, we will then be reviewing crude oil and reminding people that oftentimes it can set a dismal low in January, February. So financial markets be okay until mid-year, and then we'll be watching for our technical work to get us defensive.
And Bob, a story you might want to comment on. Our friend Mike Swanson from Wall Street Window has noted that people who were never in the stock market before are getting into it, and those people were the ones who used to bet on professional sports. With no professional sports going on, they've now turned their attention to the stock market. Are they going to find it, quote, interesting?
Oh, I hadn't read that, Jim. That's a wonderful observation, that no current professional sports to wager on, so, hey, let's go over and play the stock market. Now, that's going to be an interesting one to see, because, I don't know, maybe some of those people who wager on sports events are also already stock traders, so who's to say, but it sure is an interesting observation.
Bob, thank you so much for being on the show.
Well, good to be with you, Jim, and look forward to next week.
My guest has been market historian Bob Hoye, the chief investment strategist for chartsandmarkets.com. As you've heard, Bob loves to answer your questions, so you can send them to info@housestreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HoweStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HoweStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HoweStreet.com radio is a production of Howe Street Media Incorporated.